What if I told you the rich don't use their own money to get rich? They use something else, something anyone can learn. They understand how money moves. They know how to raise it, borrow it, multiply it, and protect it. They do not guess. They use systems. They do not just work harder. They think differently, and that's why they keep winning. Most people think wealth is about earning more. But the truth is, wealth is about using money the way the wealthy do. This is not a secret anymore. You're about to learn how billionaires raise money, how companies grow without cash, and how average people can use the same playbook to change their lives. It's not complicated. It's not a scam. And no, you don't need to be born rich. You just need to understand the rules. This is the passive path. And today we're going deep into how capital actually works. If you stick around, you'll walk away with the tools to build something real, even if you're starting with nothing. Let's start by clearing up one big mistake. Most people buy stocks without understanding what they are. They hear buy low, sell high, and think that's the whole game. But ask yourself this: when you buy a stock, what are you actually buying? Are you buying a piece of paper, a line on a chart, or something more? The answer matters, because if you do not know what you're buying, how can you know if it's worth it? This is where most people lose money, not because they're unlucky, but because they don't understand what they're doing. They follow hype, they chase trends, they get caught in cycles of winning and losing with no real progress. It's like digging a hole, then filling it up, then digging it again, round and round. No real wealth, just noise. You've probably seen it too. Someone makes a big gain in the stock market. They brag. They seem smart, but 5 years later they're still broke. Why? Because the money never stayed. They treated investing like gambling. And gambling never builds wealth. That's not a judgment. It's a pattern. If you want to break that cycle, it starts with understanding one simple thing: what is capital? Capital isn't just money, it's money used to make more money. Money for consumption is one thing. Capital is something else. If you spend it, it's gone. If you invest it, it grows. That's the difference. That's the edge. So what is a capital market? It's where people who have capital meet people who need it. Simple, like a job board is for hiring, like Craigslist is for used furniture. A capital market is for funding. Companies go there to raise money. Investors go there to grow money. That's it. If you run a business and need funds, you go to the capital market. If you have money and want returns, same place. It's where the exchange happens. Understanding that puts you ahead of most people. Because now you're not just thinking about money, you're thinking about what it does and who controls it. Keep watching. Because next, we're diving into the two ways companies raise money and how you can use both in your own life. There are only two ways to raise money for a business: debt or equity. Either you borrow it or you sell a piece of ownership. That's it. Let's break that down. Imagine you start a food truck. You need $20,000 to buy equipment and get rolling. Option one, you go to the bank, you ask for a loan. They agree, but they want collateral. You offer your car as security. They charge you interest. Now you owe the bank money. That's debt. You keep full ownership of your business, but you owe someone else. Option two, your friend offers the same $20,000, but instead of a loan, they want 25% of your business. No interest, no payback schedule. But every dollar you make, they get a cut. That's equity. Now your friend is a co-owner. That's the trade. Control versus cash. Debt gives you money, but keeps control. Equity gives you money, but costs ownership. Both have pros and cons. Smart entrepreneurs learn to use both. The rich use debt to grow faster. The wise use equity to reduce risk. And the best use the right one at the right time. You can too. The key is to know the difference and apply it on purpose. Because if you don't choose your path, someone else will. The passive path is about building wealth with intention. And this is where intention starts. Next, we're going deeper into debt, how it works, how to use it, and how the rich make it pay for itself. Debt is not always bad. Used right, it builds wealth. Used wrong, it destroys it. The difference is purpose. Let's say you borrow money to buy a flat-screen TV. You enjoy it, but the money is gone. Now you're paying interest on something that loses value. That's bad debt. Now imagine borrowing to buy a rental property. The rent pays the loan. The value grows over time. That's good debt. One costs you, the other pays you. Most people only see one kind, so they fear all of it. But the rich think differently. They ask one question before taking on debt. Will this debt make me more money than it costs? If the answer is yes, they move fast. Let's look at how this works in business. You run a bakery. You want to open a second location. You don't have the cash, but you have equipment worth $50,000. You go to the bank, they appraise your equipment. They offer you a loan for $40,000 at 8% interest. You sign the contract. Now you have debt. You also have opportunity. If your second location earns more than the loan costs, you win. And here's the key. Banks lend based on assets and trust. Not just your idea. You need something to back the loan. Property, inventory, cash flow, that's collateral. The more collateral, the more you can borrow. The lower the risk, the better the terms. This is why wealthy people build assets. Assets unlock more capital. Capital builds more assets. It's a loop, a flywheel, and you can step into it at any level. Start small, use credit wisely, protect your reputation, build relationships with lenders, and always have a plan to repay. Debt isn't dangerous, misusing it is. Next, we'll talk about bonds, how they're just another version of smart debt, and how you can use them too. Bonds are just organized IOUs. You borrow from many people instead of one. Each person gives a small amount. You promise to pay interest, then return the full amount later. That's a bond. Let's say you need $100,000 to grow your coffee business. You don't want a bank loan, you don't want to give up ownership. So you sell 1,000 bonds at $100 each. Each bond pays 6% interest yearly. After 5 years, you repay the full amount. Now you have funding without losing control. And your investors earn a steady return. It's clean, it's simple, it's scalable. Big companies and governments do this all the time. They issue bonds to raise money for factories, bridges, and growth. And regular people can buy those bonds. You can too. They're often safer than stocks. They pay predictable income, but the returns are usually lower. Because risk is lower, some bonds are ultra safe, like US Treasury bonds. Others are riskier but pay more. Like corporate or municipal bonds, the key is understanding the terms, maturity date, interest rate, credit rating. Always read before you invest. Bonds are a tool. You can issue them to raise money. You can buy them to grow money. Either way, they're part of the game, part of the system. And if you understand how to use them, they can work for you. Next, let's explore equity. Why selling ownership can be powerful when used wisely. Equity means ownership. When you sell equity, you're giving someone a piece of your business. In exchange, they give you money. They're not lending it. They're buying in. You don't have to pay them back, but you also don't keep all the profits. Let's say your business is worth $1 million. Someone invests $200,000. They now own 20%. If the business grows to $5 million, their share grows too. If you sell the company, they get 20% of the sale. Equity works best when the business has high potential but limited cash. It's how most startups grow fast. They raise money from investors. They use that money to scale, and they share the rewards. But there's a cost. You give up control. The more equity you sell, the more voices you have to answer to. That's why the best founders are strategic. They only sell equity when it unlocks major growth. They protect their share, and they pick partners, not just funders. Equity can also come with dividends. If your company earns profits, you can share them with shareholders, but only after you've paid your debts. Lenders get paid first, then bondholders, then shareholders. That's the order. Equity is last in line for risk, but first in line for long-term gain. It's a bet on the future. It's shared upside, and it can build massive wealth. Most of the world's billionaires didn't get rich from salary. They got rich from equity. They owned a piece of something valuable, and that piece grew over time. You can do the same. Start something, own a share, or invest early in someone else's vision. Equity rewards patience and belief. Now let's look at how equity trading evolved and how the modern stock market came to be. The stock market started as a simple meeting place. Entrepreneurs needed money. Investors wanted opportunity. They met under trees, in coffee shops, in public squares. They traded ownership on paper. Over time, it got more organized. People posted business details on blackboards. Others came to read, ask questions, and invest. Soon there were too many deals to manage by hand. They needed structure, so they built stock exchanges. Now instead of writing deals one by one, companies could list their shares. Anyone could buy in, anyone could sell out. It became a marketplace of ideas, risk, and capital. Fast forward to today, and we have digital trading, apps, algorithms, 24-hour access. But the principle is still the same. You're buying ownership in real businesses. You're sharing in their success or failure. The price of a stock reflects what people believe about the company. If investors expect growth, they buy. That pushes the price up. If they expect trouble, they sell. That pushes the price down. Supply and demand drive every move. It's not always rational. Fear and greed distort everything. A strong company can see its stock crash on bad news. A weak company can see its stock rise on hype. That's why understanding the business matters, not just the chart, not just the news, but the fundamentals. Revenue, profit, debt, leadership, market position. Those are the roots. Stock price is just the leaves blowing in the wind. To win in the market, you don't need to outsmart Wall Street. You need to understand what you're buying and why you're buying it. That's what turns noise into opportunity. Next, we'll dive into investor behavior and how emotions shape the market more than logic ever could. Markets move on emotion, not logic, not spreadsheets, but fear and greed. When people feel optimistic, they buy. They push prices higher. When people panic, they sell. They drive prices down. This creates cycles, booms and busts, euphoria and crashes. It's not new. It's human nature. Think back to when stores ran out of toilet paper. People didn't need more. They were afraid, so they hoarded. The same thing happens in investing. When a stock is rising, people rush in. They don't want to miss out. When it falls, they run away. They don't want to lose more. This creates bubbles and bursts. Most people buy at the top and sell at the bottom because they follow feelings, not facts. Smart investors do the opposite. They stay calm when others panic. They get cautious when others celebrate. They buy when value is clear, not when hype is loud. They understand that price is not always equal to value. Sometimes a good company trades cheap. Sometimes a bad company trades high. Knowing the difference is everything. That's why emotional control is more important than a perfect strategy. Discipline beats excitement. Patience beats speed. The market rewards those who think clearly while others react. Next, we'll look at two major investing styles and how to pick the one that fits you best. Here are two main ways people invest: momentum and value. Momentum investors follow the trend. They ride waves, they buy what's going up and sell before it comes down. They move fast. They react to charts, to news, to patterns. It's about timing and speed. Value investors do the opposite. They look for hidden gems. They study companies. They buy what's underpriced. Even if no one is talking about it, they hold for the long term. They care more about business quality than stock movement. Let's compare. Momentum is like surfing. You catch a wave, you ride it. But wipeouts are real. Value is like planting a tree. You water it, you wait. Then harvest. Both methods can work, but they require different skills. Momentum needs discipline and exit plans. Value needs patience and research. Warren Buffett is a value investor. He bought Coca-Cola when it was cheap. He held it for decades because he believed in the business. He didn't care about short-term swings. He knew the brand would last. If you prefer fast moves and tight stops, momentum might fit. If you enjoy reading, thinking, and waiting, value might suit you better. The key is to pick a style that matches your personality, not someone else's. Copying someone's trades won't work if you don't share their mindset. Invest with honesty, invest with clarity, and don't chase what you don't understand. Now let's explore how to analyze a company before you invest. So you're not just buying stocks, you're buying real businesses with your eyes open. Before you invest in any company, learn what it does. Start with the basics. What does the company sell? Who are its customers? How does it make money? These are simple questions, but most investors skip them. Next, look at the numbers. Revenue is total income. Profit is what's left after expenses. Margins show how efficient the business is. A company making $10 million with $1 million profit has a 10% margin. Higher margins usually mean better business health. Then check the debt. Too much debt is risky. Can the company cover its interest payments? If not, that's a red flag. Also look at growth. Is revenue increasing year over year? Are profits stable or rising? Consistency matters more than hype. Review their leadership. Do they have a clear vision? Are they honest with shareholders? Good leadership builds long-term value. Next, understand their business model. How do they get customers? Do they rely on one product or multiple income streams? More diversity usually means more stability. Finally, compare it to others in the same industry. Is it stronger, faster growing, more profitable? Don't invest just because the price looks cheap. Cheap can still be expensive if the business is weak. You're not buying a lottery ticket. You're buying a piece of a real business. Think like an owner, not a trader. The more you understand the company, the less you need to rely on luck. Next, we'll talk about the most valuable investment you'll ever make, and it's not in the market. The best investment is in yourself. No stock beats a smarter brain. No bond pays more than better judgment. When you grow your skills, you grow your income. When you grow your mindset, you grow your options. Start with reading. Books on money, business, psychology. They cost little, but change everything. Then learn from people. Find mentors. Watch interviews. Study those who've done what you want to do. Their lessons can save you years. Next, practice. Start small businesses. Try new tools. Track your spending. Budget your income. Make mistakes early. Learn fast. Your first business might fail. Mine did. Your first investment might lose. Mine did too. But every lesson sticks. Every rep counts. The more you know, the less you fear. The more you try, the more you learn. Education is not just school. It's books. It's conversations. It's action. And it compounds. Just like money. So before you chase the next hot stock, ask yourself this. What's one skill I could learn today that makes me more valuable? Could I understand taxes better? Could I write better? Could I sell something online? These are small doors, but they lead to big rooms. If you want more income, become worth more. That starts with knowledge. Now let's talk about the myths that hold people back and how to break free from them. Most people don't fail because of money. They fail because of belief. They believe things that keep them broke. Like investing is gambling. No, it's not. Gambling is random. Investing is research. It's planning. It's ownership. Another myth is the rich are just lucky. But luck without discipline doesn't last. Most rich people took risks. They learned skills. They reinvested their wins. Luck might start the journey, but habits finish it. Then there's debt is always bad. Wrong again. Bad debt buys stuff you can't afford. Good debt builds cash flow. It buys real estate. It launches businesses. It creates income. People also believe money is evil, but money just amplifies what's already inside you. If you're kind, it helps you help more. If you're greedy, it makes it worse. Money isn't moral. It's a tool. It's fuel. One more myth. If I try and fail, I'll look stupid. So what? Everyone who wins once failed. It's part of the process. The only real failure is doing nothing. The world rewards courage, not perfection. Replace your limits with questions. Instead of saying, I can't afford it, ask, how can I afford it? Instead of saying, I don't know how, ask, who can teach me? Your beliefs shape your results. Change them, and your future changes with them. Next, we'll look at what the rich do differently, and how you can do the same, starting now. The rich don't think about money the way most people do. They borrow to invest, not to consume. They use credit to build, not to buy things they don't need. They own assets, things that produce income, not just bills, not just stuff. They protect their time. They say no often, because time is their most limited resource. They automate what they can. They delegate early. They don't chase every dollar. They focus on scale. One good idea, multiplied. One system, repeated. They reinvest profits. They don't spend every win. They let the money cycle back into the engine. They play long games. They think in decades, not in weekends. And they track every dollar, every return, every loss, not to stress, but to learn. That's the mindset. That's the model. And you don't need millions to live it. You can start now by treating your money like capital, by learning how to raise it, manage it, and grow it. The passive path is about building wealth that works for you, not wealth that works you to death. Now let's talk about how to start, even if you only have $100. Start with what you have, even if it's just $100. Open a Roth IRA, buy a low-cost index fund, set up automatic contributions. $5 a week is a start. Build the habit first. The amount will grow later. Pay off high-interest debt. That's a guaranteed return. Track your spending. Cut what doesn't move you forward. Use the savings to invest. Buy books. Learn skills. Take a course on sales, or coding, or marketing. Start a side hustle. Sell something simple. Freelance a skill. Flip items locally. Don't wait for the perfect idea. Take imperfect action. Test. Learn. Repeat. Invest in tools that save you time. Use tech to organize your money. Budget apps, spreadsheets, reminders. Build a credit score. Pay on time. Keep utilization low. A strong credit score opens more doors. Be consistent. Wealth doesn't come from big wins. It comes from small habits, done daily. Every dollar has a job. Make sure it's working for you. Now let's bring it all together and lay out the action steps to build your own passive path. You've learned how money works. You've seen how businesses raise capital. You understand debt and equity. You know how to read a company. You've seen how emotions move markets. You've learned how the rich use systems, not guesses. Now it's time to act. Start by reading one book about money. Just one. Highlight it. Apply one lesson. Next, open a basic investment account. Fund it, even if it's small. Set up recurring deposits. Make it automatic. Start tracking your net worth. Know what you own. Know what you owe. Take one step to improve your credit. Pay off a small balance or reduce your spending limit. Review your subscriptions. Cut what doesn't serve you. Take a weekend to list every skill you have. Circle the ones people will pay for. Offer that skill online, even if it's $5. Build the muscle. Learn from the feedback. Repeat. Watch your mindset. When fear comes up, question it. When doubt shows up, write it down. Then take a step anyway. Build systems, not goals. Habits, not hype. Keep it simple. Keep it steady. This is the passive path. A path to freedom. Built one smart decision at a time. Like the video. Subscribe for more. And share this with someone who needs a fresh start. You don't have to be rich to build wealth. You just have to start where you are, with what you know, and grow it from there.